Ever heard the saying, when you play with fire, you get burned? Well, in crypto, some of the brightest minds and boldest traders have been torched, liquidated in spectacular fashion. Let me walk you through the wildest wipeouts in crypto history and the lessons every beginner needs to hear. First up, Suju and Kyle Davies, the masterminds behind Three Arrows Capital. At their peak, they managed billions, but their downfall was textbook overconfidence. They bet big on risky stuff like GDTC and the Terra ecosystem using massive leverage on FTX, Deribit, and BitMEX. When Luna crashed, their $3.5 billion empire crumbled. Lesson? Even geniuses can lose everything if they use too much leverage in a bull market. Then there's Sam Bankman-Fried, the face of FTX. He ran both the exchange and his trading desk, Alameda Research. It looked brilliant until risky trades using customer funds backfired. FTX collapsed, vaporizing more than $8 billion. Lesson: when there's no transparency and too much leverage, disaster is just around the corner. Let's talk Arthur Hayes, the man behind BitMEX. He didn't get liquidated, but his users sure did. BitMEX was famous for 100x leverage, so when markets moved, billions in user positions got wiped out instantly. Lesson: platforms that push high leverage usually end up with mass liquidations. And then came Duquan's Terra Luna disaster. When UST lost its peg, Luna's supply exploded and the whole ecosystem evaporated, over $40 billion destroyed on exchanges like Binance and KuCoin. Even the safest coins melted down. Lesson: if it sounds stable but it's algorithmic, don't trust it blindly. Remember BitConnect? Carlos Matos hyped it up, but it was a Ponzi scheme in disguise. Billions lost, millions of victims. Lesson: if someone promises you easy, steady profits, it's probably a scam. And don't forget the roaring kitty copycats. Chasing meme stock glory with 20x leverage on Robinhood ended with thousands losing life savings, over $100 million gone. Lesson: social hype is not a trading strategy. Finally, the infamous Ethereum flash crash on Kraken. One big sell order, zero liquidity, and ETH nosedived from $1,600 to $700, liquidating everyone on high leverage. Always use a stop loss. So if you're new here, take notes. In crypto, leverage is a double-edged sword, and hype can kill your bankroll. Play smart, survive longer.
Ever wondered who the true masters of the crypto and Forex markets are? Today, I'm diving into the stories of legendary traders, people who turned smart strategies into massive profits. Let's get inspired and maybe learn a thing or two for our own trading journey. First up, George Soros, the man who broke the Bank of England. Back in 1992, Soros bet big against the British pound, believing the UK couldn't hold its currency in the European rate mechanism. His conviction and timing, spot on. He pocketed over $1 billion in just a single day. The lesson here? Macro insight and perfect timing can make history. Next, Jim Simons, the quant king. Through his medallion fund at Renaissance Technologies, Simons used pure math and data. His fund pulled in an insane 66% annual return year after year. The big takeaway? Emotionless algorithmic trading can actually outsmart gut feelings. Now let's talk about CZ from Binance. While he started as a trader, he shifted gears and built Binance, the world's largest crypto exchange. His net worth shot up to $96 billion. Sometimes building the infrastructure is even more rewarding than trading itself. Then there's Sam Trabucco, a genius from Alameda Research. He made hundreds of millions by spotting price differences between exchanges. Think FTX, Binance, Coinbase, and moving fast. The lesson? Arbitrage, math, and speed equal high profits. Grit Trackelhoon, the DeFi whisperer, went deep into protocols like Uniswap, Curve, and Aave. By farming during bull markets and understanding DeFi tools, he earned over $50 million. Early research and timing are powerful. Michael Burry, yep, the guy from The Big Short, made $700 million betting against the housing market. Now, he's trading crypto and warning about market risks. Contrarian thinking backed by data pays off. Finally, Peter Brandt, a charting legend. For decades, he's mastered classical analysis, breakouts, head and shoulders, and more. On platforms like Bitstamp and Coinbase Pro, his secret, patience, discipline, and sticking to the charts. So, what can you take away? There's no one-size-fits-all path. Some use math, some use timing, others build tools or trust their charts. But every master started as a beginner, just like you. If you want to trade, learn, experiment, and maybe one day, your story will inspire others too. Before there were algorithms, before the screens, before the bots, there were men in suits shouting across chaotic trading floors. This is the story of how trading strategies evolved from hand signals and gut feelings to AI-powered bots that make thousands of trades per second. Let's explore how the game changed and how smart traders always adapt. Back in the 1970s and 80s, trading was manual and instinct-driven. Floor traders on the New York Stock Exchange and the Chicago Mercantile Exchange relied on order books, human emotion, and physical signals. Their strategies were simple but powerful. Support and resistance, those price zones where everyone's waiting for a bounce or a break. Tape reading, literally watching the ticker tape to feel the market's pulse, and spot where the big players were moving in. Then there was arbitrage, finding price differences between similar assets on different markets by hand. One legendary name from this era? Paul Tudor Jones. He predicted and shorted the 1987 crash using just technical charts and trendline analysis. That was groundbreaking back then. Then came the internet, charting software, and platforms like MetaTrader 4 in the early 2000s. Suddenly, anyone could trade. Retail traders flooded in. Forex exploded. Strategies shifted. They became more data-driven and repeatable. Traders were scalping, making dozens of tiny trades on one-minute charts. Others swung with trends over days or weeks. There were breakout traders waiting for price to smash through a level with volume. And trend followers using moving averages and indicators to ride the market's direction. This was also when candlestick analysis, originally from 18th century Japan, became global. For the first time, traders could truly visualize market psychology. Crypto changed everything. With 24/7 markets and wild volatility, traders had to adapt, fast. Now it wasn't just about price and volume. News-based trading surged, buying or selling on the latest headlines, ETF approvals, regulatory bans, you name it. On-chain analysis popped up, studying wallet activity, token movement, smart contract metrics. Traders hunted for arbitrage between platforms like Uniswap, Binance, Coinbase. And with so much hype, it became critical to spot pump and dump schemes, especially on obscure coins. Even the classics evolved. For example, people tweaked RSI thresholds for crypto because it's way more volatile than Forex or stocks. Today's elite traders? They're often machines. Big firms like Renaissance Technologies, Citadel, Jump Trading. These guys use quant models, pure math, no emotion. High-frequency trading is huge microsecond-level orders, servers sitting right next to the exchange. There are machine learning bots that literally adapt and get smarter with every trade. Even retail traders have powerful tools now. TradingView scripts, Pine script bots, and APIs that connect to Bybit or Binance. AI-based tools recommend strategies in real time, scanning market sentiment, Twitter, and volume data. So, what's the lesson? Markets always evolve, and so must your strategy. Whether it's Soros, shorting the pound, a scalper on EUR USD, or a bot trading 50 crypto pairs at once, the best traders study history, embrace tech, and never stop adapting. Don't chase every strategy. Pick one that fits your psychology, your risk tolerance, and your time. Master it. Because in this game, it's not the smartest who win. It's the most adaptable. End of episode 3. Subscribe for episode 4 on brokers and exchanges. You've heard the saying, not your keys, not your coins. But what about your trades? The truth is, whether you're in Forex or crypto, your success depends as much on your strategy as it does on the platform you use. Today, I'm uncovering the evolution of brokers and exchanges, from shady market makers to billion-dollar empires, and what every trader must know before clicking buy. Let's roll back to the early 90s. Retail Forex trading? It didn't exist. Only institutions, hedge funds, and banks could access global currency markets. Then, the internet changed everything. Suddenly, retail brokers like Forex.com and FXCM appeared, letting anyone trade currencies from their laptop. But here's the catch. Most of these early brokers were market makers. They didn't send your order to the real market. They traded against you. Some, no surprise, manipulated prices, hunted stop losses, and even stalled withdrawals. A classic case. In 2015, after the Swiss franc shock, FXCM faced massive losses and was banned by US regulators for misleading clients. So, ECN brokers emerged. ECN stands for Electronic Communication Network. These brokers connect you directly with liquidity providers, offering raw spreads, just a tiny commission on top. Today you'll see names like IC Markets, Pepperstone, and Ducascopy. But remember, not all brokers are created equal. Now let's jump to crypto. In the beginning, crypto trading was underground. Mt. Gox launched in 2010 and, at its peak, handled 70% of all Bitcoin trades. Then, disaster. In 2014, hackers stole 850,000 Bitcoin. The site disappeared. Users lost everything. From that wreckage came new giants. Binance, fast, global, with massive coin listings. Coinbase, US-based and heavily regulated. Kraken, KuCoin, BitGet. These exchanges brought spot trading, futures, options, staking, you name it. But here's the thing, they're centralized. They hold your funds. If they collapse, you could lose everything. Remember FTX? In 2022, it was the second largest crypto exchange. It fell apart overnight, $8 billion in customer assets gone. That's why decentralized exchanges, or DEX, are gaining ground. Think Uniswap, PancakeSwap, DYDX. No middleman here. Trades run on smart contracts, you hold your keys, no one can freeze your funds. But DEX aren't perfect. You'll deal with high fees, especially on Ethereum. There's risk of smart contract bugs. And if you're trading low-volume tokens, liquidity can vanish, causing slippage. CX, centralized exchanges, offer convenience, leverage, and deep liquidity, but they require trust. DEX give you control, but they come with a learning curve. Smart traders use both, picking what fits the situation. So, how do you pick the right platform? Treat it like choosing a parachute. It needs to work when you need it most. Look for regulation. Forex brokers should be licensed by the FCA in the UK, ASIC in Australia, or SciSec in Europe. For crypto, US platforms like Coinbase follow SEC and FinCEN rules. Check liquidity. High daily volume means your trades go through smoothly, without slippage. Transparency matters. Can you see the order book? How does the platform make money? Are withdrawals fast? Security is non-negotiable. 2FA cold storage insurance funds. Binance, for instance, keeps a $1 billion insurance fund called SAFU. And let's not forget fees. Avoid hidden spreads or sneaky withdrawal tricks. Lastly, user control. In crypto, hardware wallets and non-custodial trading are the future. Here's the bottom line. Brokers and exchanges aren't just middlemen. They're the gatekeepers of your money and your freedom. So before your next trade, ask yourself, do I really know who I'm trusting with my funds? Because the best strategy in the world is worthless if you're trading it on a ticking time bomb. End of episode 4. In episode 5, I'll explore the indicators that have stood the test of time, from 1970s equities to 2025 crypto bots. In a world of hype indicators and flashy trading bots, some tools have quietly stood the test of time. From Wall Street legends in the 70s to crypto whales in 2025, these indicators still work, if you know how to use them. Today, I'm breaking down the timeless indicators that professionals rely on, and how you can master them too. Let's start with a quick history lesson. Trading indicators have been around since the 1960s. Some of the most powerful tools, they came from real traders, not computers. J. Wells Wilder, a mechanical engineer turned trader, gave us things like the RSI, ATR, and parabolic SAR, indicators built for commodities and Forex that now show up everywhere, from crypto to stocks. What makes them timeless? They measure what matters: momentum, trend, volatility, and overbought or oversold conditions. Let's break down the 5 most powerful and time-tested indicators. First up, RSI, the Relative Strength Index. It measures momentum on a scale from 0 to 100. Above 70, overbought. Below 30, oversold. It's great for spotting reversals and divergence. Pro tip in strong trends, RSI can stay overbought or oversold longer than you'd expect. So, don't use it blindly. Next, moving averages, SMA and EMA. They show the average price over time and act as dynamic support and resistance. The 50 and 200 EMA are the most popular. Golden cross is when the 50 crosses above the 200, bullish. Death cross, 50 crosses below 200, bearish. EMA reacts faster, making it better for short-term traders. Third, MACD, moving average convergence divergence. It combines momentum with trend direction. When the MACD line crosses the signal line, it can mean a trend reversal is coming. Works best on 4-hour and daily charts. Use the MACD histogram to catch early momentum changes. Fourth, Bollinger Bands. They show price volatility by using 2 standard deviations from a moving average. If price bounces outside the bands, that's a volatility spike. It can mean breakout or fake out, so use volume for confirmation. In sideways markets, a Bollinger Band squeeze can lead to explosive moves. Fifth, volume profile and on-balance volume. These help confirm if price moves are real. Rising price but falling volume, big warning sign. Breakouts on high volume, that's a strong continuation. Combine volume with RSI or MACD for safer entries. Now here's the secret, using just one indicator is like flying a plane with one instrument. It's risky. Pros use confluence, combining 2 or 3 indicators that confirm each other. For example, the 200 EMA is trending up, RSI bounces off 40, and MACD shows a crossover. That's a high confidence long entry. But avoid indicator overload. Too many indicators give conflicting signals and cause hesitation. Master a few and understand how they interact with price action. Let's talk mistakes. Treating indicators as magic, shorting with RSI in a bull market, ignoring volume or trading every crossover. These are rookie moves. Here's what really matters. Indicators don't predict, they confirm. Use them with context, a solid plan, and risk control. And always test them across different assets and time frames. What works on Bitcoin might flop on USD JPY. The best traders aren't the ones who know the most indicators. They're the ones who master a few, know when to use them, and trust their edge. Indicators are tools, not magic, but in the right hands, they can guide you through the chaos, one candlestick at a time. That's it for episode 5. Next time I'm breaking down the best and worst coins in crypto history, from Bitcoin's rise to Luna's destruction. Subscribe because you don't want to miss that one. Before you place your first trade, stop for a second. Over 90% of new traders lose money. Some even blow up their accounts in just a few days. It's not about being smart or dumb, it's about knowing what you're getting into. Today, I'm breaking down the 7 golden rules every trader must know if you want to survive and actually thrive, whether you're trading crypto, forex, or stocks. Memorize these. Rule 1, never trade with borrowed money. If you're thinking about using a loan or your rent money, stop. Trading isn't a guaranteed paycheck, it's a business. Losses are part of the game. When you're desperate to win, you'll make desperate decisions. And that's how accounts die. Start small, only use what you can afford to lose. Grow with skill, not pressure. Rule 2, master one strategy, not 10. Beginners try everything. Scalping one day, swing trading the next, RSI today, Fibonacci tomorrow. The pros, they master one setup and stick to it. Find your edge, backtest it, trade it over and over. Don't collect strategies, be a strategy sniper. Rule 3, always use a stop loss. Trading without a stop loss is like driving a car with no brakes. Even pros are wrong 40% of the time. The key is controlling those losses. Risk just 1 or 2% per trade and let small losses protect you from disaster. Rule 4, leverage is a double-edged sword. Sure, brokers offer crazy leverage like 50x or even 100x, but high leverage multiplies risk, not just reward. A tiny move against you can wipe you out. Stick to 5x or less. Build skill first, then think about leverage. Rule 5, don't trade without a plan. Every trade needs 3 answers. What's your entry? Where's your stop loss? What's your target? Plus, what time frame are you using? What news could shake things up? Are you trading your plan or your emotions? Plan your trade your plan, always. Rule 6, emotions are your biggest enemy. Fear, greed, hope, revenge, these kill more traders than bad strategies. Win a trade, you get cocky. Lose a trade, you chase revenge. Market spikes, you FOMO in and buy the top. Set rules, stick to them. The best traders detach from the outcome and focus on execution. Rule 7. Demo before you deposit. Would you fly a plane without training? Didn't think so. Demo accounts exist for a reason. Learn the platform, manage your positions, build confidence. Don't go live until your strategy is consistently profitable. Then start small. Grow with proof, not hope. The market doesn't care how smart you are. It only respects discipline, preparation, and patience. Before you place your first trade, ask yourself, am I trading for freedom or just chasing dopamine? Am I prepared to lose before I win? Trading isn't easy money, it's earned skill. But if you follow these 7 rules, you're already ahead of 90% of beginners. End of episode 6. Thanks for watching. Want a bonus episode on building your first trading system? Let me know in the comments. So you've learned the rules, you know what to avoid, you're ready to trade seriously. But here's the truth. Traders don't succeed by guessing. They succeed because they have a system, a repeatable plan that tells them when to enter, when to exit, and when to walk away. In this episode, I'll show you how to build your first profitable trading system, step by step. Let's get started. First up, choose your style. Before anything else, decide what kind of trader you really are. Are you a scalper? That means trades lasting just minutes. It takes fast execution, total focus, and super low spreads. Maybe you're more of a day trader, getting in and out within the same day so you never wake up to surprises. Or you might be a swing trader holding for days or even weeks, catching bigger moves with less screen time. And then there's position trading, the long game, often in crypto or stocks. I can't stress this enough. Pick a style that matches your personality and your schedule. If you've got a 9 to 5, don't force yourself to scalp. Step 2. Select your market and your time frame. Pick 1 or 2 markets to start. Maybe it's Forex, like EUR, USD, or GBP, JPY. Could be crypto, BTC, ETH, or those spicy low-cap gems, or maybe stocks. Stick to high-volume names like Apple, Tesla, or Amazon. Once you've got your market, pick your time frame. Day traders usually stick to 5-minute, 15-minute, or 1-hour charts. Swing traders go with 4-hour or daily. Position traders, daily or weekly, use one main time frame to make decisions and check a higher one to confirm the trend. Step 3. Define your entry conditions. This is where most people mess up. Your entry trigger needs to be written down and crystal clear. No gut feelings allowed. Here's an example. I go long when the 50 EMA is above the 200 EMA, RSI bounces off 40, and the MACD shows a bullish crossover. Easy, right? Other entry styles? There's the breakout. Jump in when price smashes through a key level with big volume, or a pullback, buy the dip to a support or Fibonacci level, or catch a reversal, like a double bottom plus RSI divergence. Just make sure you have at least 2 confirmations, like price action plus an indicator. Now step 4, plan your exit. A solid system always knows when to leave. Set your stop loss. It could be based on ATR, a key support level, or just a percent of your account. Then your take profit. Aim for a risk-to-reward ratio of at least 1 to 2. If I risk $100, I want to make at least 200. Exit if RSI shoots over 70 or price hits resistance. And think about partial exits. Lock in profits, trail your stop, or scale out as you get close to your target. Step 5. Risk management rules. Without this, even the best system falls apart. Decide how much you'll risk per trade. 1 to 2% of your total capital max. Set a cap on how many trades you take and a daily loss limit. Maybe a 3% drawdown, then you stop. This stops revenge trading and keeps your emotions in check. The truth? Pro traders last because they control risk, not because they win every time. Step 6. Backtest and journal. Before you trade with real money, test your system on old charts or in a demo account. See if it works in trending markets and ranging ones. What's your average win versus loss? How many losses come in a row? Keep a journal. Log the date, setup, result, and what you learned. You don't need a perfect win rate. Even 40% can be profitable if your risk to reward is solid. Here's the bottom line. Your trading system is your weapon. Not something you copy from others, but something you craft for your own mindset. And remember, simplicity wins. Consistency beats complexity. One tested system is worth more than 100 strategies on YouTube. Build your system. Trust it. Refine it. That's how the professionals do it. End of episode 6. In the final episode, I'll break down the top traders in history and what you can learn from their mindsets and methods.